Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Welcome back, everyone. Today we're diving into a really fascinating area, actually, where technology meets manufacturing.
Yeah, it's a space that's changing fast.
Absolutely. We're going to unpack the Q2 2025 earnings call from Xometry. Now, they talk about building digital rails in the custom manufacturing market.
A great phrase for what they're doing.
It is, and our goal here isn't just, running through the numbers. We want to really get under the hood, understand the strategy, the tech, especially their use of AI that's driving some pretty significant growth.
And profitability, too, which is key in this sector.
Right, in a sector that's known for being, well, complex and incredibly fragmented. So get ready for, I think, some surprising facts, some really remarkable financial results, and a look at how this digital marketplace is shaking things up in what's traditionally been a very offline world.
And it's a good time to look at Xometry. Because when you think about custom manufacturing, I mean, the sheer size of it and how traditional it's always been.
Very traditional.
You've got thousands of small shops, right? Machine shops, fabricators. They've always relied on relationships, word of mouth, manual processes. Xometry's digital approach just stands out completely.
It really does.
And what's striking, I think, is how well it's working. They seem to be thriving, really gaining market share, even when the global economy is, let's say, cautious.
That's a great point. It's not just surviving, it's actively growing in this climate.
It really speaks to how powerful this digital model can be when applied to an industry that was, frankly, ready for it.
Exactly. And those Q2 numbers, they really back that up. They validate the model. So let's start there with the financials because they are pretty impressive.
Yeah, let's get into it.
Total revenue hit $163 million for the quarter. That's a strong 23% jump year over year.
Solid growth.
But here's what really caught my eye if you break it down. The marketplace revenue is the powerhouse. It came in at $148 million.
Wow. Yeah, up 26% year over year. That's significantly outpacing their supplier services revenue, which was $14.3 million.
So the core marketplace is really firing on all cylinders.
It seems like it. So beyond just saying they're taking market share, what does that strong marketplace growth really tell us about why buyers are moving away from those old ways, especially now when maybe budgets are tighter?
That's the core question, isn't it? It signifies a fundamental shift, I think. It's not just about grabbing share, it's about businesses reevaluating how they get custom parts made.
Sure.
Think about the old way. It was often a black box, right? You'd call a few local places, send blueprints, wait, maybe days, maybe weeks for a quote.
With not much transparency.
Exactly. Pricing wasn't clear, quality could vary, lead times were uncertain. If your main supplier had an issue, you were scrambling. Xometry basically tears down that whole opaque structure.
Buyers are moving there because they get instant quotes, often AI-powered. They get access to this huge, vetted global network of suppliers. There's transparency, predictability, things the old model just couldn't offer reliably.
So it's about reducing risk and speeding things up.
Precisely. De-risking the supply chain and letting customers move faster, innovate faster. Maybe the surprising part is just how quickly this traditionally slow-moving industry is jumping on board. It shows that even deep-seated habits change when the value is overwhelming, especially when efficiency is paramount.
And that efficiency really shows up in their margins, doesn't it? Record overall company gross margin at 40.1%.
Strong number for this kind of business.
And even more telling, the marketplace gross margin hit a record 35.4%. That's up 190 basis points year over year.
Yeah, and that jumped nearly 2 full percentage points on the marketplace margin. That's not trivial.
No, definitely not.
They directly link that expansion to their AI, specifically the pricing and selection algorithms getting better and better.
Okay, so the AI is directly contributing to profitability.
Absolutely. Think about where they were, maybe 25% gross margin on the marketplace just 4 years ago. Now they're consistently over 35%.
That's a huge leap.
It is. And each quarter, as they grow and the tech improves, it seems to power the next step up. It's like a virtuous cycle, that 190 basis point improvement you mentioned.
Yes.
Across $148 million in quarterly marketplace revenue.
Yeah.
Well, you be the math. That's nearly $2.8 million in additional gross profit just this quarter compared to last year's margin rate.
Wow, okay. That frames it really well.
That's real money they can reinvest, more R&D, faster international expansion, maybe even acquisitions, without necessarily needing more outside capital. It fuels the whole engine.
So that progression from 25% to over 35%, what were the main hurdles they had to clear to get there? And what does it say about how mature their AI has become?
Well, the biggest hurdle initially was likely the sheer complexity and, frankly, messiness of the data in manufacturing.
Right, nothing standardized.
Exactly. Every part is different. Materials vary. Processes have nuances. Building AI that could accurately price jobs and match them to the right supplier across thousands of diverse shops and millions of part designs, that took immense effort. Data collection, cleaning, constant algorithm refinement.
A massive undertaking.
For sure. So that climb from 25% to 35% plus margin signifies that their AI is really maturing. It's getting much, much better at finding that sweet spot, the right price for the buyer, the right job for the supplier's capacity, and ensuring Xometry's profitability.
It learns constantly.
Every transaction makes it smarter. It refines pricing, understands supplier capabilities better. It's a self-improving system that gets more efficient and profitable with basically every single order that goes through it.
That's remarkable. And it's not just the margins improving. Their adjusted EBITDA hit a major milestone, too.
Yeah, that was a big one.
Positive $3.9 million. Compare that to a loss of $2.7 million in Q2 last year. That's a $6.6 million swing.
Huge improvement.
For a company focused on growth, investing heavily in tech, what does hitting positive adjusted EBITDA really signal about the long-term viability of this whole model?
It's critical. It's like a validation point. For a company that's been pushing hard on growth, pouring money into tech and expansion, getting into positive adjusted EBITDA territory shows the market that the underlying business model is sound and sustainable.
It proves the investments are paying off.
Exactly. It says, look, our investments aren't just driving revenue, they're now creating real operational leverage and improving the economics of each transaction. It signals a move towards sustainable profitability.
Okay.
It suggests the core marketplace is now strong enough to cover its operational costs and start generating cash, which, implies they're managing costs well, even while scaling up.
And that leads right into the operating leverage point they highlighted?
It does. Total non-GAAP operating expenses only went up 10% year over year.
Okay.
Now remember, revenue grew 23%.
Right, much faster. That's the gap you want to see.
That's textbook operating leverage. And digging in, sales and marketing costs actually decreased as a percentage of revenue by 180 basis points.
Interesting. Getting more efficient there.
And G&A expenses down 170 basis points as a percentage of revenue. Even their specific marketplace advertising spend was down 130 basis points year over year relative to marketplace revenue.
So they're growing revenue significantly faster than their operating costs are increasing.
Precisely. It shows really impressive capital efficiency, especially for a company still in a high-growth phase.
That does sound incredibly disciplined. So for us listening, how does that kind of spending discipline and this clear operating leverage, how does that help their long-term financial health, their ability to keep scaling? It feels like they're building something really solid.
It's absolutely fundamental. This discipline means they're squeezing more revenue more efficiently out of every dollar they spend. It's not just about cutting costs randomly. It's about making their spending smarter and more impactful. This financial prudence builds a foundation for sustainable profit. It lets them fund growth initiatives like more AI development, new markets, maybe even buying smaller tech companies from their own operations, rather than always needing external funding.
Which reduces risk and dilution.
Exactly. It strengthens their long-term financial health, lets them keep investing in the tech that gives them their edge, and makes them more resilient. And we saw that play out regionally, too. The U.S. segment really powered the profitability.
What were those numbers again?
U.S. adjusted EBITDA was $6.9 million. That's a 5.1% margin and a $6.6 million improvement from last year. Huge swing.
Wow.
Meanwhile, the international segment still showed an adjusted EBITDA loss, about $2.9 million. But that was roughly flat compared to last year.
So still investing heavily overseas.
Correct. It reflects those ongoing strategic investments they're making to build out their global scale. They're playing the long game internationally, funding future growth, while the U.S. is already showing strong profitability and leverage.
Makes sense. And speaking of that long game and having the financial runway, let's touch on their cash position and that recent debt refinancing.
Yeah, important moves there.
End of Q2, they had a healthy $226 million in cash, equivalents, and marketable securities. Down slightly, but they said that was mainly due to tech-related CapEx, which fits the strategy.
Investing in the core platform.
Right. But the really interesting move was completing that $250 million convertible debt refinancing. New notes, 0.75% coupon, due 2030. Can you break down why that was such a smart strategic move? It sounds like more than just kicking the can down the road.
Oh, absolutely. It was a very shrewd piece of financial management. It hits several key goals simultaneously. First, the big one, extending maturity.
Pushing it out to 2030.
Exactly. They had a significant chunk of debt coming due sooner, around 2027. Pushing that out to 2030 buys them a lot of breathing room, reduces near-term pressure, gives them stability.
Okay, that makes sense.
Second, look at that coupon, 0.75%. That's incredibly low,
Yeah, very low interest.
which means lower interest payments, freeing up more cash flow for operations or investment. Third, and this is crucial for shareholders, they structured it to minimize potential dilution.
How so?
They achieved an effective 75% conversion premium. Basically, the stock price has to go up quite significantly, 75% above the conversion price set in the deal before these notes would convert into equity.
So it protects current shareholders from dilution unless the stock performs extremely well.
Precisely. It's much more favorable than a lower premium.
Mm-hmm.
So by tackling over $200 million of principal that was due in 2027, they've strengthened the balance sheet, boosted their financial flexibility, lowered costs, and reduced risk around their growth plans. A really well-executed transaction.
So stepping back, why is that kind of sharp financial maneuvering, especially refinancing debt like this, so important for a tech company that's growing fast but also needs to keep investing heavily even as it turns profitable? It's clearly about more than just saving on interest payments.
It's absolutely fundamental. It's about maintaining flexibility and runway.
For a tech company that needs to pour resources into R&D, talent, maybe M&A, market expansion, having a strong, flexible balance sheet is like oxygen.
Okay.
It lets them make those crucial investments without being handcuffed by short-term cash needs or forced to raise equity when market conditions might not be ideal.
So it keeps their options open.
Wide open.
Yeah.
It provides a buffer against economic bumps, like the ones we're seeing now. It lets them jump on strategic opportunities, enhancing their AI, entering new countries, maybe buying a complementary tech. It basically de-risks their whole ambitious growth plan and ensures they can keep funding the innovation that drives everything.
That's a great explanation. And that innovation engine brings us right to the next key area, the role of AI and technology in Xometry's whole story.
The absolute core of it. They explicitly call AI a competitive moat, something that keeps getting deeper, strengthening the platform. And it seems like a top priority, with their new president focused on accelerating tech and AI deployment to really cement their position as those digital rails for manufacturing.
It's clearly not just a feature, it's woven into their identity, their strategy. Calling AI a moat tells you it's fundamental to how they compete and win.
Right.
And the president's focus confirms it's a top-down mandate. They're committed to constant improvement, using the latest AI, generative AI included, to make the experience better for both buyers and suppliers.
So what do these digital rails actually look like in practice? How do they change the game?
Well, think about it before. Getting custom parts was like navigating a maze, right? Days of calls, emails, waiting for quotes, unclear pricing, uncertain delivery. For suppliers, it was hunting for local work, managing capacity manually.
A lot of friction.
Tons of friction. The digital rails Xometry built are essentially a standardized, transparent, super efficient digital pipeline. It connects buyers and suppliers globally, automating everything, instant quoting, matching jobs, quality checks, logistics, even payments.
Making it almost like ordering online, but for complex industrial parts.
That's the goal, making custom manufacturing accessible, predictable. And they're constantly adding new features, new products that make these rails even smoother and faster.
Okay, let's get specific then. What are some recent examples, especially things that help the buyers? How are these rails improving that customer journey?
For buyers, a big focus is on instant quoting and selection. They've expanded instant quoting to cover new additive manufacturing materials, think advanced plastics or special metal alloys.
Okay.
And they added a really neat feature, the ability to dynamically view 2D technical drawings right within the quoting process.
Ah, so you don't have to toggle between systems or emails.
Exactly. Think about how much time that saves. Traditionally, you send a drawing, someone interprets it, maybe questions go back and forth, then you get a price. Here, buyers get faster, more accurate quotes almost instantly. It boosts their agility, helps them get products to market quicker, better outcomes, less hassle.
That sounds like a huge time saver, a real friction reducer. What about this team space solution? That sounded like a push towards collaboration, especially for bigger companies.
Yes, TeamSpace is really important for their enterprise strategy. It's a cloud-based platform they launched in Q2 across Europe, UK, Turkey too. It basically lets different people within a customer's organization collaborate on manufacturing projects and orders right inside Xometry.
Like a shared workspace for manufacturing projects?
Kind of, yeah. Designers sharing files, engineers reviewing specs, procurement placing the order, all in one place. The impact is significant.
Yeah.
It drives much deeper engagement within those large companies.
And leads to more users within that company adopting Xometry.
That's the idea, what they call viral buyer growth. As one team uses it successfully, other teams see the benefits and start using it too. It helps Xometry spread organically within these big, valuable accounts.
Smart.
And building on that, in Q3, they launched more integration features for enterprise customers in Europe. This lets buyers order parts from Xometry without leaving their own procurement systems, like their ERP.
Seamless integration.
Right. It automates the data flow, streamlines purchasing, cuts down on manual entry and errors. It's all about embedding Xometry deeper into the workflows of these large organizations, making it indispensable.
Okay, so clearly making life easier for buyers, integrating tightly. But what about the other side? The suppliers, what's new for them? They're crucial to this whole network.
Absolutely crucial. A key development for suppliers is the Workcenter mobile app. They started testing an improved mobile version of their Workcenter platform. That's the cloud system suppliers use to manage jobs back in July.
Making it easier to use on the go.
Exactly. The app lets suppliers do more from their phone or tablet. They can view complex 3D part files, share photos of work in progress with the buyer, get instant push notifications about new jobs or updates.
So better communication and easier management.
Right. It's all designed to boost supplier engagement and efficiency. Make it simpler for them to manage their shop's workflow through Xometry, respond faster, communicate better. A more engaged, efficient supplier network ultimately means better service and quality for the buyers. It strengthens the whole ecosystem.
It sounds like a balanced approach, improving things for both sides. And internally, how is Xometry using AI to make its own operations, the rails themselves, more efficient and accurate?
A great example is the new AI capability for extracting information from technical drawings, also rolled out around July.
Okay, what does that do?
It automates the process of pulling out all the critical details from those complex engineering drawings, dimensions, tolerances, material specs, finishing notes, everything.
That sounds like something that used to be very manual and error-prone.
Highly manual, very detailed, and yes, prone to human error. Automating this means Xometry can process, quote, requests faster and more accurately internally. It directly improved their own quoting speed and supplier matching.
And they plan to enhance it further.
Yes, they mentioned further enhancements are planned to speed up instant quoting for even parts that rely heavily on those detailed technical drawings, which has always been a bottleneck in traditional manufacturing. It makes their core engine faster, smarter, and more scalable.
Got it. And you mentioned Thomas Renet earlier. What's happening there? How does that fit in?
Right, can't forget ThomasNet, big acquisition, huge platform. They've rolled out a new search experience using natural language processing.
So searching like you talk.
Pretty much. Describe what you need in plain English, not just specific keywords. They said early tests showed a 10% plus lift in buyer engagement because it's just more intuitive.
Makes sense.
And in Q3, they're launching a new ad-serving tech for new advertisers on ThomasNet, aimed at boosting ad uptake and engagement across that massive user base.
And Thomas Net's role is primarily
It's a giant in industrial sourcing and digital marketing. Millions of registered users, tons of suppliers. It acts as a massive funnel, bringing in both potential buyers who might later use the Xometry marketplace for transactions and suppliers looking to get found online or digitize their sales. It feeds the whole ecosystem.
Okay, so it's clear this isn't just one or two tech projects. It's a constant, accelerating cycle of innovation across the board. How does all this tech development tie back directly to their customer growth strategy? You mentioned land and expand.
It's the absolute engine of their land and expand strategy. All these improvements, instant quoting, team space collaboration, ERP integration, they lower the barrier for a new customer to try Xometry, maybe for a small, urgent project. That's a land.
Get a foot in the door.
Exactly. Then, once that customer sees the benefits, the speed, the efficiency, the value, especially for tricky parts, they're much more likely to start using Xometry for more routine work, integrate it deeper, spend more over time. That's the expand.
The tech makes the platform stickier.
Incredibly sticky. It changes Xometry from just another vendor into a strategic partner embedded in their operations. That's how they capture a growing share of that customer's total manufacturing budget. It's a really smart interplay between tech innovation and focused sales execution.
That makes a lot of sense. We've laid out the tech, the financials, the strategy. But the ultimate proof is customer adoption. Why are customers, especially big, demanding enterprises, choosing Xometry? What are the core reasons they're trusting these digital rails?
They outline four main reasons, and they all tie back to what we've been discussing. First, obviously, is driving innovation for better outcomes.
The AI-driven benefits.
Right, the constantly improving price, speed, and selection from the AI marketplace. For buyers, that means faster, more accurate sourcing, more transparency.
Right.
That helps their companies be more agile, get their products to market faster. It's a competitive edge for them.
So speed, efficiency, innovation enablement, that's number one. But in today's world, with all the disruptions we've seen, I bet there's more to it than just speed and price. What's the next big problem Xometry solves?
You hit it exactly.
Hmm.
The second reason, which became crystal clear during the pandemic and related supply chain chaos, is improving supply chain resiliency.
Ah, yes. Huge issue.
We all saw how fragile traditional supply chains can be. Geopolitics, natural disasters, labor shortages. If your main supplier gets hit, you could be completely stuck.
Scrambling to find alternatives.
Right. Xometry's marketplace tackles that head on. It gives buyers instant access to this huge, diverse, global network over 4,000 active suppliers, so they can instantly diversify, reduce dependence on one supplier or one region.
Build in redundancy.
Precisely. It enhances their overall resilience. In today's unpredictable world, having that flexibility, that global network, that asset-light model, it really resonates with companies trying to navigate all the volatility. It's a safety net with options.
It really feels critical now. I remember hearing stories during the height of the disruptions. Companies desperate for just one specific part, production lines halted. How does Xometry practically prevent that kind of panic? It seems like it's moved from a nice-to-have to a must-have.
It absolutely has. Resiliency isn't a buzzword anymore. It's crucial for business continuity. Xometry offers a direct solution. Say a company needs a critical part and their usual supplier has a machine down or there's a regional lockdown.
Yeah.
Instead of weeks of frantic searching, potentially losing millions in stalled production, they can log into Xometry, find another qualified supplier, maybe even in a different country, and potentially get that order rerouted within hours or days.
Mitigating massive risk.
Huge risk mitigation. It prevents costly downtime, ensures continuity, lets companies react quickly. That kind of agility is invaluable when things are unpredictable.
Okay, that's a powerful value prop. What's the third reason customers, especially the big enterprises, are choosing Xometry? How are they scaling up to meet the needs of these giants?
Third is delivering a truly scalable enterprise offering. It goes beyond just placing orders. We talked about the tech-powered land and expand. As these big companies adopt tools like Teamspace for collaboration or integrate Xometry directly into their ERP systems.
They become more embedded.
Exactly. Deeper embedding reduces friction for the buyer and lets Xometry capture more and more of that company's manufacturing spend. They gave a great example, becoming a preferred supplier for a major European aerospace company.
Aerospace, that's demanding.
Very. This company chose Xometry not just for the platform's ease of use, but for the reliable business model behind it. They moved off a legacy system and now use Xometry for everything from quick prototypes to ongoing production parts.
Wow.
And they highlighted that this type of customer could potentially spend $10 million or more annually with Xometry. It shows the platform can scale to handle the volume and complexity demands of the largest industrial players. It's a huge vote of confidence.
Definitely validates their enterprise strategy.
Yeah.
Okay, and the fourth reason. Sounds like it's about making the ecosystem work for the suppliers, too.
Precisely. The fourth key is driving value back to that global supplier network. This is crucial for making the whole marketplace sustainable and attractive.
How do they do that?
Several ways. The marketplace lets suppliers, big and small, sell their unused machine time digitally, accessing global demand they likely never reach otherwise. That boosts their revenue and efficiency.
Filling up their capacity.
Right. Then they get the cloud-based Workcenter platform to manage those jobs more efficiently, scheduling, communication, etc. And critically, Xometry offers fintech tools like faster payments,
Improving cash flow for the suppliers.
which is often a major pain point for smaller shops.
Right.
So it creates this virtuous cycle. Better tools, more global business, and faster cash for suppliers leads to a stronger, more diverse, more capable network for the buyers. It's a win-win that strengthens the entire marketplace.
That paints a really clear picture of why the model is gaining traction. Okay, let's pivot now to some specific performance metrics and their outlook, especially thinking about that macro environment. Buyer growth looks solid. Q2 active buyers hit almost 75,000.
74,777 to be exact,
Yeah.
up 22% year over year.
And they added over 3,300 net new active buyers in the quarter. But interestingly, revenue per active buyer on the marketplace was also up, about 4% year over year. They said that was mainly driven by enterprise growth in the US.
Yeah, that's a good sign. It means they're not just adding more customers, but the customers they have, especially the larger ones, are spending more. It shows increasing engagement and monetization.
Geographically, the US marketplace grew 25% year over year, but international growth really stood out.
It had accelerated, yeah. 31% year-over-year growth internationally. They specifically mentioned the Team Space launch in Europe helping drive that, so the global expansion seems to be hitting its stride.
And the enterprise story continues to look strong. Accounts spending at least $50,000 in the last 12 months grew 15% year over year.
Reaching 1,653 accounts, and importantly, that was up 108 accounts just from Q1. Good sequential growth there.
And they see those $50 K plus accounts as the top of the enterprise funnel, right? What does that imply for future growth, tying back to that land and expand idea?
Exactly. That $50 K threshold is their key indicator for identifying companies with significant potential. Seeing strong growth there means their pipeline for larger expansion is healthy. These are the customers that are successfully landing and who are most likely to expand their spending significantly over time as they integrate Xometry more deeply.
So it feeds the future growth engine.
Right. And they also mentioned continued strong growth from the really big accounts, those already spending over $500,000. Those are the ones they see having the potential to become $10 million plus annual accounts eventually. So the strategy of attracting and growing high-value enterprise clients seems to be working well.
It's impressive they're achieving this, especially given the macro headwinds we keep hearing about. Manufacturing PMIs have been sluggish, suggesting caution out there. How does Xometry keep growing like this if the overall sector is hesitant? It seems a bit counterintuitive.
It's a really important point they addressed directly. They stated clearly that their growth is not coming from a booming manufacturing sector. They see the caution too.
So where is it coming from?
Primarily two things. One, consistently taking market share away from traditional, offline, less efficient methods. Two, the fundamental shift towards adopting digital marketplace models like theirs.
The value proposition becomes even stronger in tough times.
That's the argument. Their platform is described as purpose-built for change and uncertainty. When companies are focused on efficiency, cost savings, speed, and especially supply chain resilience, all the things Xometry delivers, the value proposition, becomes even more compelling. If you need to optimize, you look for better tools.
Makes sense. What about reshoring? Is that helping them?
They mentioned they source the vast majority of U.S. orders domestically, so they're well-positioned if reshoring accelerates. But they were cautious, saying, while it could be a long-term tailwind, it's too early to say it's a major driver yet. The current growth is really about market share gains and the platform's inherent strengths.
And the momentum is continuing.
They said Q3 started strong. More adoption globally, the AI keeps getting better. They seem confident the model works regardless of the macro cycle, maybe even because of it sometimes.
That context certainly makes their raised guidance stand out. Let's look at that. For Q3, they're guiding to revenue between $167 and $169 million.
Yeah, that's 18% to 19% growth year over year. Still very solid.
And marketplace growth projected around 20% to 22%, and significantly adjusted EBITDA expected between $4 and $5 million.
Big improvement from the slight loss in Q3 last year. Shows that profitability trend continuing.
Definitely. Not just growth, but profitable growth.
And the full year picture got brighter too. They bumped up the marketplace growth outlook for 2025. Used to be at least 22%. Now it's 23% to 24%.
Okay, raising the bar.
And overall 2025 revenue growth now expected to be at least 20%. Notably, that's faster than the 18% growth they saw in 2024. So acceleration on the top line for the full year.
That's a strong signal.
And they're forecasting a full year incremental adjusted EBITDA margin of around 21%, meaning a good chunk of every new revenue dollar should flow down to adjusted EBITDA. That operating leverage is really kicking in.
So despite acknowledging the macro caution, the raised outlook really signals strong confidence in their demand, their execution, and the power of this digital model. Okay, let's unpack this a bit more. We've just heard about a company achieving record revenues, hitting profitability milestones, expanding globally, and doing it all by embedding AI deep into an industry many would call, traditional, old school even.
Definitely not known for cutting-edge tech historically.
Right. They're building these digital rails where fragmented analog ways used to rule. But what does this really mean for you, listening to this? Is Xometry's success just sort of a one-off story in custom manufacturing, a unique case, or is it maybe a preview? A glimpse of what's possible for any market that's fragmented, still largely offline, when you really embed digital transformation and smart algorithms right at its core. Could this be a blueprint?
That's a really thought-provoking question. If these digital platforms can unlock so much value efficiency, resilience in something as complex as global manufacturing supply chains, which are notoriously bespoke and relationship-heavy, well, where else could this model work? What are the next frontiers?
Hmm.
Could we see similar transformations? Maybe in other specialized fields, things that rely on expertise and relationships, but haven't fully gone digital marketplace yet.
Mhm.
Maybe specialized consulting or certain types of equipment leasing or even complex project management coordination.
Industries still relying on phone calls and spreadsheets, perhaps?
Perhaps. And if so, what are the ripple effects? What does it mean for how work gets done in those fields, how value is created? The implications could be quite broad, touching everything from individual business efficiency to the future structure of global trade itself. It's definitely something to think about.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.